So we will quickly recap Unit 3, that is the third head of income, which is profits and gains of business or profession. So which deals in section 28 to 44D. 28 being the charging section will tell any income or any profits and gains of any business or profession which was carried on by the assessee at any time during the previous year. If you have earned any profits and gains from that, it is chargeable to tax under this head. Okay. Section 29 talks about computation of income under this head. How to compute a taxable business income or a professional income. So you will take net profit as per profit and loss account as a base. For that you will make some adjustments, that is add few items, deduct few items. So what will I add it, sir? So if there is any expenses which is debited in profit and loss account, but as per income tax it is disallowed. As per income tax act, disallowed. Or else you have debited in your profit and loss account excess expenses. That is expenses you have debited more. In that case assume you have debited 10,000, but as per income tax act only 8,000 is allowed. So 2,000 should be disallowed. Agree? And third case is if there is any income which is taxable under the PGBP but not credited to P&L account, you have to add back that also. Agree? Then coming to deduction items, if there is any expenses which is allowed as per IT Act but not debited in P&L account, you have to deduct it. Agree? Then if you have credited any income to your P&L account which is not taxable under the PGBP or which is not at all taxable, that is which is exempt from tax, you have to reduce it. Agree? And if there is any overvaluation or undervaluation of opening stock and closing stock, you have to make the adjustment accordingly. Treat opening stock similar to your expenses and closing stock similar to your income or sales. Clear? Then coming to section 30 to 36. Section 30 to 36 will tell what expenses are allowed in income tax. In an income tax, and they give some specific deduction. Whereas section 37 will give some general deduction. So what are those? One by one we will see. Section 30. So any expenses incurred for the purpose of business premises, that is building, which is revenue in nature, can be claimed. Agree? So if it is capital in nature, you can claim depreciation on building, guys. Agree? Then expenses on business assets like plant and machinery, furniture, equipments and all. If it is a revenue in nature, you can claim under section 31. If it is capital in nature, capitalize that and claim depreciation on that. So depreciation under which section? Section 32. So section 32 deals with depreciation, which is mandatory for every assessee to claim under Income Tax Act. Agree? So, and there are rates which are given in the Act itself. So whatever rates are given in the Act, actually it is given in rules, income tax rules, we have to compulsorily apply that rate only. Agree? So what is the format to compute the depreciation under section 32 is, you have to take opening WDV on the opening day of the previous year. For that, if there is any asset purchased in the previous year, you have to segregate that into two parts. Whatever asset has been purchased in the previous year and put to use for 180 days or more. 180 days or more. Then other assets which are purchased and used for less than 180 days. Because sir, why this segregation is? See, normally if I use the asset in the previous year for 180 days or more, I can claim full depreciation. If depreciation rate is 10%, I can claim full 10%. Whereas if I used any asset for less than 180 days, then I can claim only 50% of normal depreciation. That is, if depreciation rate is 10%, I can claim only 5%. Then if any assets are sold during the previous year, you have to reduce it from the block. Agree? Then you will get the WDV for the purpose of depreciation. On that figure, calculate depreciation. On that figure, calculate depreciation. Agree? So once I reduce depreciation from that, I will be getting closing written down value, which I will show in my balance sheet. Agree? So on one more important point is, in income tax, we always follow WDV method, that is written down value method for purpose of calculating depreciation. Only for power sector, option has been given to either follow WDV method or SLM method, that is straight line method. So in income tax, we always calculate depreciation on block basis, guys, not individual asset basis, it is on block basis. That is, we categorize, we classify whichever asset is having the same class and same rate of depreciation, we will put all these assets in one block. Agree? So assume there are 100 assets whose class are same, it is of same nature and their same rate is also same. In that case, we will put all these 100 assets and make one block and we will give name for that block. And depreciation can be claimed on block basis. Agree? And when it comes to net sale proceeds, any assets sold during the previous year should be reduced. Agree? And we cannot claim depreciation on that. Whatever asset is going out of the block, we cannot claim depreciation on that. And sale proceeds includes any insurance compensation or scrap value received also. Agree? If any asset is disposed of and we have got any scrap value, we have to take that also. Agree? And there is no question of calculating profit or loss on sale of asset. Agree? Chalo. Then what are the conditions? There are various conditions for an assessee for him to claim depreciation. What are those? Assessee must be the owner of the asset, okay, and such asset must be used for the purpose of business or profession in the previous year, okay. But there are few exceptions for this. That is, if I have purchased any asset on hire purchase basis, or else I am staying in a building which is taken on rent, but I have incurred some capital expenditure. Clear? Then, if any asset is acquired and put to use in the previous year for less than 180 days, then only 50% of depreciation I can claim. Agree? Then, if the asset is put to use means even if it is ready to use, we will consider it as put to use and we will start claiming depreciation on that. Agree? Then there is no question of profit or loss, we have already discussed. Then WDV method should be calculated. Then F point, depreciation under section 32 will fail in two situations. Whenever depreciation under section 32 fails, immediately we will compute capital gains under section 50. Agree? When will depreciation fail in under section 32 is when all the assets are block, when all the assets in the block are sold irrespective of their value, or else I have sold only some assets in the block but there is no value in the block. That means your sale value is more than your WDV. So in that case we cannot claim depreciation under section 32. So section 32 will fail and section 50 will pitch in to calculate capital gains. Clear? Then if any new plant and machinery is purchased by a manufacturing entity and installed in factory, they can claim additional 20%. Normally on plant and machinery depreciation rate is 15%. Over and above that, in the first year of purchase only we can claim additional 20%. Even for this 20%, that 180 days criteria is applicable, guys. So what are some important depreciation rates I have given here? For building, if it is used for residential purpose, 5%. Other than that, then 10%. Furniture and fixtures, 10%. Plant and machinery, under that there are various categories. If motor car, motor buses or motor lorry or taxis used in the business of hiring, then it is 30%. Normally it is transportation company which are covered here. Then motor car other than used in business on hire, that is for normal business I am using motor cars. In that case 15% depreciation. Then for books, computer and computer software depreciation rate is 40. For all other plant and machinery 15%. If in the exam if they use only the word plant and machinery, always apply 15%. Then for all intangible assets depreciation rate is 25%. But for one intangible asset, that is license fee, for a telecommunication services company, they can claim amortization on that. So throughout their license life, they can claim amortization and not depreciation. Agree? This is only applicable for telecommunication company. Then coming to section 35, which talks about scientific research. Scientific research can be of two things. I myself are doing scientific research. In that case, whatever capital expenditure I incur other than land, 100% allowed. Okay. Whatever revenue expenditure I incur, 100% allowed. Agree? And one more additional benefit they are giving. Any capital or revenue expenditure incurred prior 3 years before the commencement of business also I can claim it. Agree? But revenue, only two things can be claimed. What is that? Salary for a research personnel and cost of raw materials. Agree? And for capital expenditure, land cannot be claimed. Agree? And one more research I can do, that is in-house research in the field of biotechnology. In that case, I can claim 150% deduction for both revenue as well as capital expenditure. But land and building is not covered there. Agree? Then this is with respect to my own business. I can also contribute to the outsider who is doing some research, either social science research, statistical research or science research. So if I am contributing to someone, even though it is not related to my business, still I can claim 100% deduction in my business. That is, I can debit it to my P&L account. Clear guys? Chalo. And those people should be approved. That is one important point. For whomever I am contributing, they should be approved. Next, capital expenditure with respect to specified business. So if I am doing any business, if it is a specified business, then I should treat it as separate business. So what is specified business? They are given some list, 8 to 10 businesses. If you are doing any of that business, then you are engaged in that specified business. So for specified business, if you incur any capital expenditure other than land, goodwill and financial instrument, you can claim 100% deduction in the year in which you have incurred it. In the year in which you have incurred it. But if you have incurred any capital expenditure before commencement of your business, you can claim it in the year in which you commence your business. And for the specified businesses, there are a lot of conditions, like if there is any loss from specified business, you cannot adjust it against any other income. You cannot even adjust it against any other normal business income also. Agree? Next, preliminary expenses, the expenses which are incurred before the commencement of business or for the purpose of extension or expansion. It can be claimed in 5 equal installment guys, but it is restricted to 5% of cost of project or capital employed. Okay, and it is available only for Indian company and other non-corporate who are resident in India. Clear? This is what with respect to some special case. Then comes 36(1). Under 36(1) there are various things. We will see one by one. Insurance premium paid. If I have taken any insurance policy on my stock and if I am paying premium on that, I can claim it as a business expenditure. Then health insurance premium paid on the employees of the company can be claimed provided it is not paid in cash. Even 1 rupee cannot be paid in cash. Agree? Then bonus and commission paid to the employees can be claimed as a deduction provided it is not paid as profit or dividend, and it is subject to 43B. What is 43B? We will see later. Then interest on borrowed capital. If any loan is taken for the purpose of business, whatever interest is paid on that can be claimed as business expenditure. But if any loan is taken for the purpose of acquiring an asset, then whatever interest I pay till the asset is put to use can be capitalized to claim depreciation. Even interest is subject to 43B. Then contribution to provident and other fund. This is what is covered here is employer contribution. If employer contribution to provident fund or any other fund can be claimed as a business expenditure subject to 43B. Agree? What is 43B? We will see later. Next, employees contribution guys. This is important. So if employees contribution is there, first it is treated as an income of a assessee. Then if it is deposited within the due date of the respective fund, it is allowed as an expenses. Agree? Then loss of animals. If any animals are used in my business as assets and if it dies or permanently become useless, in that case whatever loss I am suffering, I can debit it to my P&L account. Agree? That animals should not be a stock for me. Next, bad debts. Bad debts written off in the books can be debited to your P&L account. Then provision for bad and doubtful debts. Normally it is not allowed. Only for some financial institutions like bank, state, financial corporation, for them it is allowed. That too subject to certain conditions and restrictions. Agree? Then expenses on family planning. So it can be both capital, revenue. If it is capital, you can claim it in 5 installment. If it is revenue, you can claim in the same year. Then securities and commodities transaction tax. Assume you are engaged in buying and selling of securities or commodities, and whatever you get income from that transaction is your business income. In that case, securities transaction tax or commodities transaction tax is allowed for you as business expenditure, because buying and selling of securities or commodities itself is your business. Agree? So securities transaction tax and commodities transaction tax, we treat it as business expenditure. So we are done with 36. 37(1) will tell any other expenses you have incurred but not covered from section 30 to 36, we will allow it. We will allow it provided following conditions are satisfied. Sir, what are those? It is not covered from section 30 to 36. It should not be capital in nature. It should not be personal in nature. Then it should not be immoral or illegal. And last condition is it should not be specifically disallowed. There are some expenses which are disallowed. So whatever expenses you are incurring, it should not be disallowed. Agree? Then explanation also they are given. If any expenses are offense in law or prohibited by law, it is not allowed, like bribe. Okay, and CSR expenses, that is corporate social responsibility. Whatever expenditure you incur for the benefit of society is not allowed for you as business expenditure. So 37.1 done. Next we are coming to disallowance expenses, guys. Disallowance expenses, that means even though you have incurred these expenses, you cannot debit it to your P&L account because you are violating some provisions as per Income Tax Act. So what are those? One by one we will see. Pay attention. If TDS is not deducted, or else if TDS is deducted but not remitted to the government within the due date of filing the return of income in the following two cases. Following three cases are there. So first, if any payment is made to a non-resident or a foreign company, in that case if you have not deducted TDS or deducted but not remitted to the government within the due date of filing the return, then 100% disallowed. 100% disallowed. Then if you are making any payment to resident in the nature of interest, contract payment, commission or brokerage, rent, royalty, fee for professional services, only 5 items are covered. In that case, if you are not deducted TDS or if you have deducted but not remitted to the government, then 30% will be disallowed. Please be careful with this. 30% is disallowed. Agree? 30% is disallowed, whereas in the previous case 100% is disallowed. And one more case is given, which I have given in 5th point. If any salaries is paid to a non-resident or if salaries is paid outside India, if TDS is not deducted or else deducted but not remitted to the government within the due date of TDS, then it is completely disallowed, permanently disallowed. Whereas in the following two cases, which is given in first point, if TDS is deducted but remitted, assume after due date, then it will be allowed in the next year. It will be allowed in the next year. Whatever is disallowed this year will be allowed in next year. Then coming to second point, if any income tax or foreign income tax or professional tax is paid, it is disallowed in income tax. Agree? Then any wealth tax also is disallowed. Then any fee paid by state government undertaking to state government, it is disallowed. Then 6th point, this is applicable only for partnership firm, guys. So in case of partnership firm, maximum interest allowed on capital and loan is 12%, provided it is given in the deed. More than 12% if you are taking, the balance will be disallowed in the hands of partnership firm. Then coming to second point, any salary, bonus, commission or remuneration to partners will be allowed, provided he should be a working partner, it should be provided in partnership deed and all, but it is restricted to some limit. Sir, what is that? We have to calculate book profit. Sir, what is book profit? Book profit is the profit of partnership firm after all expenses but before remuneration. Okay, once you get book profit on the first 3 lakh book profit, or if you are having book loss, in that case what is the remuneration you can pay to the partners? 1,50,000 or 90% of book profit, whichever is higher. On the balance, that is, assume you have book profit more than 3 lakh, on that balance amount you can pay 60%. You can pay 60%, you have to total up both, maximum you can pay this much, all partners put together. So whatever interest and salary is allowed to the partnership firm as an expenses will be taxable in the hands of partner as business income. Clear? Next 40A. 40A covers 3 important things. Here I have given only important things. So 40A2 will tell any excessive or unreasonable payment to a specified person who is a relative or associated concern is disallowed. Only to the extent of excessive or unreasonable. Okay, next 40A3 will tell any cash payment to a single person in a single day in excess of 10,000 is disallowed. But if it is if the assessee is a goods carriages, then instead of 10,000 the limit is 35,000. And for this there are certain exceptions also. Because that is, you can make cash payment in certain few cases, like if you are making any payment to banks or governments or in any rural area and all, you can make payment in cash only, no problem. Then 40A7 will tell any provision made for gratuity and all disallowed. Only when you pay you can claim it as expenses. Then comes my 43B. 43B will tell, it covers around 7 to 8 items, which will tell if you are making the following payments only within the due date of filing your return of income, you can claim it as an expenses. If you are paying after that, then you can claim it in the next year. So what are the expenses which are covered under 43B are taxes, duties, cess or fee payable under any law, taxes here means not the direct tax, indirect tax like GST, municipal tax, so and so. Then bonus and commission to employees, interest on loan, then leave encashment, amount payable to Indian Railways for use of railway asset, employer contribution to PF is covered here, or any superannuation fund. Clear guys? If the payment is made after due date, it can be claimed in the next year, that is subsequent year. Easy. Next, deemed profit. Sir, what is deemed profit? These items may not look like company has earned it, but it is considered as your business income and you have to pay tax in the year in which you actually get the benefit. So section 41 will tell, even though you are getting these items but you are not continuing with your business, still it will be taxable. Still it will be taxable. So what are those items? 4 items are covered. Remission of liability or recoupment of loss or expenditure. Assume in the past year I had provided to any liability or I had debited any expenses to my P&L account, but in this year I am recovering it. So in that case it is considered as deemed profit under section 41(1). Balancing charge means if any asset on which you are claimed depreciation under straight line method and you have sold that asset on a profit, on that case whatever profit you are earning is taxable under PGBP, as 41(2) is covering it. Next, if any scientific research assets on which you have claimed deduction under section 35 is sold by you and whatever profit you are making out of it is taxable under 41(3). Then bad debts recovered. Whatever bad debts was allowed in the previous year, if it is recovered in the current year, it is taxable as business income. Clear guys? Then coming to who should maintain the books of accounts as per income tax is given in 44AA, important section. So if you are a specified person who is carrying on some specified profession, who is that specified person? We will see first. Whoever is carrying on the profession of legal, medical, engineering, architectural, accountancy, technical consultancy, interior decoration or film artist and company secretary. For them, when should they maintain the books of account? If their gross receipts exceeds 1,50,000 in all the 3 years preceding the previous year. Don't touch previous year. Go back to the last 3 years. In all 3 years, if it is more than 1,50,000, maintain the books. Clear? Then coming to non-specified person, under that we divide that into 2 categories. First one is individual HUF. So if income from business or profession is more than 2,50,000 or sales or turnover is more than 25 lakh, I have to maintain my books of accounts in any 1 year out of last 3 years. Agree? Then coming to other SSE. Other SSE under non-specified, which covers partnership firm, company, AOP, BOI and all. So if their income is more than 1,20,000 or sales or turnover is more than 10 lakh in any 1 year out of last 3 years, you have to maintain books of account in this year. If you are starting any new business or profession in the current year, then if you feel that your income or turnover will cross the respective limits, then maintain the books of account from day 1. Agree? And if you are covered under any presumptive scheme and you are telling that no, my income is less than this, in that case come out of presumptive scheme and maintain the books of accounts. Clear? Then coming to audit case, 44AB will tell who should get their accounts audited. So in case if you are having any business, if your turnover crosses 1 crore, you should get your accounts audited. But for some small business, the limit is extended to 5 crore. But you have to receive all your receipts and you should make all your payments not more than 5% in cash. So minimum 95% should be in any mode other than cash. It is like that. Agree? So only in that case the limit will be 5 crore or else 1 crore. Then if you are carrying on any profession, limit is 50 lakhs. So if your gross receipt is more than 50 lakhs, then you have to get your accounts audited. So third, 3, 4, 5 is like if you are covered under any presumptive scheme and if you are telling that no, my income is more or less, if you are not agreeing for presumptive schemes, then you have to get your accounts audited. So under presumptive scheme, first scheme is 44AD, which is available for resident, individual, HUF and partnership firm other than LLP whose turnover or gross receipt does not exceed 2 crore. In that case, their income will be considered as 8% of their gross receipts. In few cases, instead of 8%, we will apply 6% if 2 conditions are satisfied. Agree? Then we have to pay advance tax within 15th March of every previous year or financial year, and 44AD is not applicable for few people, that is a specified professional who is covered as per rule 6F and who is having the income by nature of commission or brokerage then who is carrying on in agency business, then the assessee who is covered in 44 AE, that is who is having goods carriage business. Agree? Then these assessees cannot claim any deduction under section 40, 10A, 10AA and heading C of chapter 6A. Agree? And once you opt for this scheme, for next 5 years you have to mandatory follow it. If you want to go out of this 44 AD, then for next 5 years this scheme will not be available for you. Agree? So normally presumptive income under section 44 AD will be calculated at 8%, but it can be calculated at 6% if the following two conditions are satisfied. What are those? All full gross receipts or turnover or sales should be received in any mode other than cash, and you would have received that money within the due date of filing the return of income. Next, presumptive scheme for small professional, that is specified professionals. So it is applicable only for resident assessees whose gross receipt does not exceed 50 lakh. In that case, 50% of their gross receipts will be considered as income, and they have to pay advance tax by 15th March of previous year. Then last case is for goods carriage people. So if you are having any goods carriage business and you are not owning not more than 10 goods vehicle, you are not owning more than 10 goods vehicle at any time during the previous year, then you can opt for this scheme. Sir, what is the income under this scheme? We have to divide your vehicle into two parts, guys. Whether your vehicle is heavy goods vehicle or other than heavy goods vehicle. If it is heavy goods vehicle, when my vehicle will be called as heavy goods vehicle, if the weight of the vehicle is more than 12,000 kgs or 12 tons. In that case, my income will be 1000 per ton of gross vehicle weight per month or part of the month. Per month or part of the month. So 1000 is per ton. Okay, that is for 1000 kgs. Next, what if my vehicle is other than heavy goods vehicle? Then it is 7500 for every month or part of the month. Agree? Even if I am owning the vehicle for a single day in a month, entire month should be considered, guys. Clear? And there are some common conditions which are applicable for 44 AD, ADA and AE, that is presumptive scheme. All expenses are deemed to be allowed, but while calculating the WDV of the asset, assume that depreciation is allowed and calculate WDV. Okay? And you need, if you are covered under presumptive schemes, you need not maintain books and you need not get it audited. But only for a partnership firm which is covered under 44 AE, for them whatever deduction is allowed under section 40B for partnership firm is allowed. Clear, guys? Easy. Next, sir, what is the impact of new scheme? New scheme is available only for individuals and HUF, right? So if I am opting for new scheme, whether all the deductions and exemptions is available for me under PGBP? No. The following expenses or allowances are not allowed for you. Normally, if you are under old scheme, you can claim all this. But if you are going for a new scheme, you cannot claim. Some of the important points here are additional depreciation of 20% for new plant and machinery is not allowed for new scheme. Okay. Then if I tell next important thing, 35 AD is also important. That is specified business. Okay. Capital expenditure, it is not allowed. Then comes our scientific research. See, what scientific research are covered here is from point, I will just mark it in black, from year to year. Okay, almost all the points are with respect to donation for scientific research. So if you have given any donation for any approved institute or association, college, university or national laboratory, if you are under old scheme, you can claim 100% deduction, but if you are under a new scheme, you cannot claim deduction. The 4 points is with respect to that only. But here, if you yourself are doing scientific research, that is not excluded. So please be careful. So if you are opting for a new scheme, if you yourself is doing scientific research, then you can claim deduction. Whatever 4 items are covered here is only if you are making donations or contribution to outsider for some research purpose. Clear, guys? And some more extra sections are covered. So you just go through this. So we are done with this revision, guys. We are done with this revision.